Hey, how's everyone doing? I'll be with you shortly. Thank you for being here. Appreciate it. And mic check. Just want to make sure audio is coming in okay for you guys. And then again, looks like you got a pretty good conversation going. Appreciate you all being here once again. Quick roll call. Mr. Nguyen, how are you doing? Let's see. Alan McLemore, first time here. Great. Go ahead and type in new and where you're from. Alabama, U.S. Thanks for being here, Alan. Newton Riff, Gavin Hillbold, first time I've seen you here as well. Thanks for coming on. Red Sheckleton, a few new names. Okay. I'll be with you shortly. And again, we'll get this thing going very, very soon. Thanks for being here again. I don't know about you, but every time I hear that music, it gets me nervous. Hello again, everyone. Welcome back to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, and glad you made it. Glad you could be here. Glad I made it as well. Again, thank you for being here on your Sunday evening in the States or in Europe, and of course, your Monday morning here in Asia, and of course, in Singapore. Quick roll call again. CO2, how you doing? First time I've seen your name. James Richter, Truth Monster, how you doing again? Professor K, haven't seen you here before. Welcome. Polynesian Pip, aloha, how you doing? Anna, Krislinski, that's what we're going to be taking a looking at. The names Bond, Junk Bond 000. We're going to take a look at. I mean, just to like look what's going on with the bonds, and of course what OJ had to say that kind of spooked the markets. So we'll see how that goes in a bit. Pablo Pina, how you doing? Again, Truth Monster, Jeff 702, Seymour Rivers, how you doing? Are you going to win another book today, Seymour? You always seem to be winning the books, my friend. Let's see, Bullion Stasher. Okay, a lot of new names here. Appreciate you guys being here. And so, as always, if it is your first time here, please do subscribe, hit the bell so you can be notified of new updates, and give us a thumbs up. Again, as always, we appreciate these thumbs ups. They're like the possibly the biggest and best thing that you could do for us. We appreciate it. YouTube has decided to put us on the naughty list. For some reason, we are, as far as views go, they're quite low. But when we look at other things like iTunes, Spotify, things like that, we're doing pretty well, and it's still on an upward trend. But somehow with YouTube, we're yeah, we're kind of we got our backs against the wall here, and we're going to have to come out hard. So again, we appreciate the thumbs up. Okay, so as always, appreciate those thumbs up. And you can find us on social media, silverbullion.com.sg. SilverBullionSG is our handle for Facebook. SilverBullionPL is where you can find us on Twitter, PL for private limited. Audio versions, bit.ly, bit.ly for short, SBTV iTunes or SBTV Spotify. And as always, if you have that Telegram app on your mobile phone or if you have it on your desktop, do go ahead and join our group, Crisis Tracker. And I think you'll find some interesting articles that we put out. And we kind of dig through the weeds for you and just put out probably the more significant news as it pertains to gold, silver, economy, finance, and things like that. So do hope to see those numbers grow as well. So let's see what we got out here. What's on your minds out here? James Richter, yeah, I had to take care of a couple things, so I switched the live stream dates up a bit. Apologies for that, but here we are again. So let's see how it goes. Haven't seen you guys in a while. Always be funding. Yes, it is. Saddle up and silver up time. I mean, you guys know already know what's going on out there. Saddle up for what's coming ahead, and silver up as well. And that Reddit movement, Wall Street silver, it's pretty interesting. I don't know if you folks have been following it, but we'll touch on that lightly as well. Upcoming guest, we're going to be interviewing Stuart Englert. Stuart Englert is the author of Rigged, Exposing the Largest Financial Fraud in History, a veteran investigative reporter and magazine editor by trade. Stuart worked on publications in Indiana, Idaho, and Tennessee before authoring his first book in 2015. So we'll be talking to Stuart. I've been taking a look at some of his past interviews, and he's on it. Stuart definitely knows what's going on, so he's going to be a very, very interesting person to talk to. And we'll be giving away his ebook as our thank you ebook giveaway. As mentioned, the author of Rigged, it's the largest financial fraud in history, was not Enron's colossal accounting crimes. It was not Bernie Madoff's record-selling Ponzi scheme, or even the LIBOR scandal in which some of the world's biggest banks conspired, always conspiring there, to profit by manipulating interest rates. No, the largest financial fraud in history is one most Americans know little to nothing about, and it isn't mentioned by politicians, reported on the nightly news, or discussed by co workers during the lunch break. Rules to the game to get Stuart Englert's book Rigged, the ebook version, which we will send to you on Kindle. You're going to have to download that Kindle app from your phone or your tablet's app store. It is a free app, so no charges there. Be the first to answer correctly in this live stream before the timer runs out. You're going to have about a minute and 30 seconds. U.S. winners will be given a link to download that ebook. And winners outside the U.S., we're going to have to arrange for alternative prize. And again, it's because Kindle does not allow ebooks to be given away as gifts outside of the U.S. And you're going to have to provide us an email during this live stream. So what we will do is my colleague Vincent, he is on standby. He will mute your comments, so only we will see it, and that way you can go ahead and send your email, and it's all safe and snug. No one else will see it except us. The question is going to come from Gerald Celente's interview, so I hope you had a chance to watch it last week. Gerald opened up towards the end. I thought that was it showed a different side of Gerald, and he's we opened up the interview. I asked him how he's doing, and he said sad, which is also something different from Gerald. So I do hope you'll have time to go ahead and watch that interview. The question: when or where in New York is Gerald Celente located? And he did say it in the video. He's often said it where he's located. So we'll be looking for that answer. Where in New York is Gerald Celente located? All right, so just go ahead and take a shot, take a guess. It's somewhere in New York. And first one to get it right will be giving away that ebook Rigged from Stuart Englert. Okay, so here we go. First one looks like CO2 CO2 hash oil is saying Kingston, Truth Monster, Bronx, GJP CMDs, Kingston. Hang on, Seymour Rivers, Brooklyn, Macro 99. Let's see, Kingston, Joe Lehotoy, Kingston. All right, good guesses. Good guesses going on. Appreciate you guys participating. And let's see what else we got out there. Chris Primer is also saying Kingston. Okay, we got a few more seconds to go. Keep going. Keep your guesses coming. Fiddler Fiddlesticks, Kingston. Bill Wood, Kingston. Polynesian Pip, Kingston. A lot of guys are saying Kingston, and it's probably because you guys have got it right. It is Kingston. Kingston, New York. So we're going to take the first 5 to get it, with the winner being CO2 hash oil. I'm not going to ask you how you got that name, but CO2 hash oil is going to win that book Rigged. And the other 4, let's see, GJP. I got to go back and check what that is. Let me go back and check it again. So CJ, sorry about that. Hang on. We're going to have to go through this again. I did write it down, so no worries. We do have it there. But let me just run through this really quick one more time. Um, okay, hang on, guys. Just let me go through it again. Okay, CO2 hash oil, Kingston, number one. GJP CMD one, also Kingston. And then we had MS Crode 99 or M Schroed 99 is another one. Joe Lehotoy is another one. And then we had Chris Primer also said Kingston. So those will be the five winners. And just to prove it, here's Gerald.
The inflation numbers are totally cooked. The person that I go to is John Williams at Shadow Stats. He has the real numbers. And when you're looking at inflation in America, you're looking at 20, 30% numbers. Where I am in Kingston, New York, we're 90 miles north of New York City, according to Bloomberg, of all of the 181 cities in America, the prices have gone up here the most, 18%. They're flooding out of New York. New York City is dead.
Yeah. It's always eerie when he says that. Staying with Gerald, we're going to go back and take a look at two other clips from our recent interview with Gerald. And you guys are right. I do see some of that out there where he originally is from Brooklyn, but he's settled in Kingston, and that's where we're going to go with. The answer is going to be Kingston. But like I said, I got the smartest bunch of people watching out there. You actually knew even where he was originally from. So again, staying with Gerald, we're going to take a look at two clips from last week's interview, and I do hope you have a chance to watch it. And these are some things that Gerald said.
The business of America is war. The business of China is business. While America wastes trillions and trillions of dollars with their military defense that haven't won a war since World War II, can't even win in Iraq, 20 years in Afghanistan, China's doing business. China's doing business. China's doing business. You look at what happened with the nation going down in 2020. Biggest defense budget. Rather than putting that money, what did China do? Infrastructure building. Hey, you see America's infrastructure? You like what happened in Texas when the whole place froze over and all the electricity went down? That's America's infrastructure. So the 21st century is the Chinese century. We're even wearing the masks.
Okay, so that's Gerald. Yeah, Texas had a deep freeze. Must have been kind of hard to make those chicken fried steaks, those famous chicken fried steaks down in Texas. But Gerald says the U.S. spent time, money, generations on war. We all know this, right? And while other countries built up their infrastructure, educational systems, healthcare systems, the U.S. remained in a perpetual war, either at home or abroad. And depending on your view, this was either the right thing to do or the wrong thing to do, maybe necessary thing to do. Again, depending on your view. But in the end, though, our politicians, and I think this is the part we can all agree on, politicians did not necessarily take care of America's business. They took care of their own business. Right. So something else Gerald Celente had to say.
The value of currencies are going to continue to decline. They can't keep printing up all this cheap money. Inflation's going to go up, and precious metals are still the very, very top for safe haven assets.
Yeah.
Everything is going to become a reality when the equity markets crash.
Okay, so precious metals are the very, very top for safe haven assets. True? Folks think this is true. I certainly think it's true. And despite all the manipulation and, let's just call it what it is, monkey hammering, precious metals do remain perhaps the most liquid, neutral, hard asset the world knows or has as money. Tinfoil vegan? Yeah, on the naughty list with honor. It's a badge of honor, but it's the way the world works. You also do need to get those views and thumbs up and things like that. So it is a badge of honor in some ways, but we also got to have one foot in reality and one foot in the real reality, I guess you could say it. Okay, so we got the names down: Chris Primer, CO2 hash oil, Joe Lehote. Okay, we got it all. Appreciate that. Thank you guys for it. I want to take another look at our website again. We'll go on over to silverbullion.com.sg. We'll take a look at the gold price right now. Bitcoin, Litecoin, Ethereum, if you got it, you can use it to go ahead and get yourself some silver and gold, and understand why people do get silver and gold. US dollars, silver is up some 57 cents, 25.88, trying to make its way back to 26. Gold up a bit, up above that $1,700 level. It was kind of borderline 1,700, 16.99, but coming back up above. And we had nickel. Nickel also was down some 16.5, 16.6 about there per ton, making its way back to 17,000 per ton. Investor kit, just go ahead and click on this link right here. You can either download it or look at it from the website and see a few different topics that we have. One of them being investing in electric vehicle battery metals. We all know there's going to be a green shift, so it is a good time to be understanding what electrical vehicle battery metals are. Definitely a good time. So you can either look at it here or you can download it. Okay, so moving on. Sign up, as always. We've been talking about this. Go ahead and sign up for an account. There are no maintenance fees. It is a free thing to do. Gold to silver ratio, 66.2. It was 67 earlier, so it's come down just a bit. 66.2 right now. And again, some featured products like nickel, which is one of those electric vehicle battery metals. Just simply click on it, and you can go ahead and store it in our vault. But to store it in the vault, you need to sign up. Again, as I've been talking about, sign up either a personal account, joint, for you and your spouse, or trust, joint with a minor, perhaps you and your child, business account, and even retirement account. These are the different accounts that we have. And when you fill it out, don't forget to mention at the bottom references. Go ahead and put YouTube or SBTV. We appreciate that. That also goes a long, long way. So let me just come back down here one more time. And the thing with nickel, again, electric vehicle battery metal, and then we have silver, LBMA bars. There's been a lot of talk about the shortage of LBMA bars. We've restocked. We were over 400. We're just now going back under 400 at 398. And when you click on the products, you're going to see a few things such as spreads. And you're also going to see how you can use it for secured peer-to-peer loan for 1 month, 6 months, 12 months, or 24 months. And you're also going to see the storage fees for a 6-month duration all the way up to a 5-year duration. And touching on these secured peer-to-peer loans, again, you can borrow against what you have in storage. You can use it as collateral. If you have gold in storage, the loan to value ratio, or LTV ratio, is 62.5%, whether it's for a 1 month, 6, 12, or 2-year loan. Whatever your gold is valued at, you can take a loan up to roughly 62.5%. Silver is the same. Silver, platinum, palladium, nickel, cobalt, 1 month loan can be valued at 62.5%. Others, 6, 12, 24, those would be valued at half, at 50%. Reason being, these metals are volatile, so that's why the little bit lower valuation that you would get there. And again, if you just scroll down a bit more, we hardly dip into these areas, and a lot of times people, they overlook it. These are accepted contracts for 1 month. Euro, SGD, USD. These are 6-month contracts. The volume basically is over time. Over time, these are the amounts that have been borrowed. These are the contracts over time that have been borrowed since we started the program. You can see the most popular contract is a 1 month Singapore dollar loan, but in volume or money wise, it's the USD 1 month loan at over $43 million. And over the lifetime, there have been over $163 million given out in loan contracts. And again, what happens is if you store with us, you need a loan, make a borrowing request. choose Singapore dollars, US dollars, or euro. Let's just choose US dollars as an example. Let's say, as these people here, they're looking for a 1 year loan or a 12-month loan. This person wants to borrow 70,000 USD. He's requesting if he can borrow at 3.25% annum. And what he's doing, or what she's doing, is she is putting up 2 kilobars of gold as collateral. Okay. And on the flip side, we have people who are willing to lend. This person is willing to lend, let's say, 125,000, but he's asking for 4.5% annum interest, which roughly breaks down to you would borrow 125,000, but you would return 131,250. This has to do with the interest that he asked for, and there is a fee from Silver Bullion, so these would be tacked on. So basically, these are what you want to look at. Go ahead and send us an email, silverbullion.com.sg, and we'll go ahead and walk you through it and work you through it. Twitter, what's going on in the Twitter sphere? Chris Marcus tweeted from Arcadia Economic, check out U.S. Treasury current 10-year, and that's been the topic lately. I saw this slightly above at 1.59 a bit earlier. Right now it's at 1.58, and we know that this is kind of spooking the markets right now, seeing that number come up. We can see how gradually since August it has been going up, but more recently, I would say since February, it has been spiking somewhat. So hang on, let me get back there. Okay. Let me just get back there a bit. Okay. Well, we're here now, 1.5. Yeah. So there we are. So it has been spiking just a bit. And I'm going to touch on this chart just a bit later. I want to show you folks something pretty interesting with this chart. Mike Maloney, great picture here. The ship cannot be sinking. My end just rose some 200 feet. So a lot of guys are up here, up in the air, up in the stratosphere, up in a bubble, and they maybe don't realize that the other end of the ship is going down. So I think this is a pretty good pictorial on how to look at the way things are going right now. So nice picture there from Mike Maloney. Wall Street Silver recently interviewed our CEO and founder, Gregor Gregerson. So let me go ahead and get the link for you. And if you folks want to go ahead and take a peek at it, this is the link to that interview. So I hope you folks have some time to watch it. If not, then if it is the wrong link, just go ahead and click on Wall Street Silver and you will find that link. Maybe I should just do it here real quick so we get the correct link. Yeah, okay, let me just redo that. Sorry about that. Okay, so let me post it in here.
The world is actually
Okay.
Singapore.
All right, for some
To give you
reason,
an idea,
it does not
or
want
was
to
until
click. Well, let me get out of here. Sorry about that, guys. Okay, so that's Twitter. Not sure why I can't put anything in the comments section. Okay. Maybe Vincent would be able to put that up. So moving forward, sorry about that, guys. TF Metals. I sincerely hope that Powell's worthless, passive, and reactive approach leads to his precious stock market to shove his toolbox directly where the sun don't shine. All right. Craig Hemke, TF Metals. There's some commentary as well here. It's status quo as far as the Fed is concerned. Dear markets, you are on your own. Here are some highlights. This is in reference to what Powell said. When pressed repeatedly if the market is right about the rate expectations, Powell refused to disapprove that. In other words, the Fed isn't too happy with the bond moves thus far. It was a disappointment for some investors who hope he would push back against the bond yield increase, and that seems to signal a push higher in yields would not test the Fed too much. Powell also said the Fed is content with the current asset purchases, and that means no extension of duration or QE twist. Well, we'll see about that. So again, Wall Street Silver. Let me come down a bit here. Hang on, guys. Excuse me. Sorry about that. So with Wall Street Silver, I'm very happy that our colleagues here at Silver Bullion, we all decided to give to the cause that they're putting up a billboard, and we donated some money here, a good amount of money to help the cause for the billboard. And this is something where I tell guys, I often tweet out to people in the States that because we are in Asia, halfway around the world, when you're asleep, we're wide awake. We're wide awake and we got your back. So we're here for you all the time. And you folks know that. So that's what's going on in Twitter. Let me get out of there real quick. And Fed head Jay Powell. I mean, I think you folks know the news, right? He spoke last week, and the markets kind of freaked out a bit. And he acknowledged jobs will pick up and inflation may pick up. And we saw stocks go down and bond interest rates went up. And I'm going to play some things that Jay had to say. But first, let me take a look at some of the comments here. Um, Hang on, let me just run through this. Appreciate the comments. Yeah, I did have a sneeze there. Thank you for bless you. Thank you. Appreciate it. Okay, so yeah, it's here in case you missed it. Hang on. Wall Street Silver's interview with Gregor Gregerson. It is posted, so go ahead and copy that. And if you have time, go ahead and take a listen. It's a pretty good interview. And we thank Gregor for taking time to go ahead and speak on certain things as they relate to silver for sure. Let's see what else is out there. Um, okay, well, let me see. I think you guys are doing okay. I'm trying to look to see if I can jump in on something. Ray Ung, yes. Using gold and silver as collateral for lending. What a greater alternative to a one of those institution places. Don't want to say the word, otherwise we're gonna remain on YouTube's naughty list. So I guess we got to be a little bit more mindful of the things we say here. But that's the idea of the peer-to-peer program. One, I mean, if you are storing your gold and silver, I mean, it's a way to keep that investment, to keep that insurance alive, and a way to put your soldiers back to work and reinvest if you'd like to. So, I mean, especially if I were holding, I mean, just me, if I were holding, maybe 500 ounces of silver, I might consider, rolling that into a nickel of a drum of nickel. I mean, it's I would, and I'm just saying for me, I would start to consider those things, and or else take out a P2P loan and use it to get some nickel or whatever else. So I mean, I'm just saying it's just me. It's not financial advice or anything like that. So anyway, let's get to Jay Powell and see what Jay Powell had to say.
Look at where we are today. The economy began to recover last May from the very sharp downturn at the beginning of the pandemic and made good progress through the beginning of the fall, let's say. And then progress slowed sharply overall with the winter COVID spike, which reduced job creation for the last 3 months through January to about 29,000 a month, which is a drop in the bucket for an economy our size. So today, we're still a long way from our goals of maximum employment and inflation averaging 2% over time. More recently, as you point out, we've got rising vaccination, we've got cases at lower levels, we've got strong support from fiscal and monetary policy, and while there's still risks, there's good reason to expect job creation to pick up in coming months. And we need.
Okay, so, and it's this statement or one piece of his statement that he had with, I think it was Wall Street Journal, some interview with them. This statement, one piece of it where jobs picking up, which sparked once again inflation fears. And there were more things that he said, but I want to take a look at some of the comments here again. Yeah, Pablo Pina, exactly. He's soothing, soothsayer, perhaps. The markets with his lavender tie, the only tool in the toolbox, the only tie in the wardrobe. No, but his money printer. That's really the only tool in their toolbox. You can name you can name a program, anything you want, but in the end, what supports your program or what makes that program come to life? Printing money. It's really the only tool that he has. So here's more things that Jerome Powell had to say.
So right now, inflation is running below 2%, and it's done so since the pandemic arrived. We do expect that as the economy reopens and hopefully picks up, we'll see inflation move up through base effects, which means just that the very low readings of March and April will fall out of the 12-month window, and also through a surge, if you will, in spending that may come as the economy fully reopens, and that could create some upward pressure on prices. The real question is how large those effects will be and whether they will be sustained or more transitory. And I'll just say that for several decades, the U.S. and the world really economy have been in a low inflation world, and low inflation is what people expect both here and around the world. For those expectations to change, businesses and people would need to believe that larger increases in prices would be repeated year after year. And we think it's unlikely that these deeply ingrained low inflation expectations would suddenly change. It is more likely that effects like the ones I described would be one-time effects as the one-time effects of the fiscal booth fade. We have the tools to assure that longer run inflation expectations are well anchored at 2%, not materially above or below, and we'll use those tools to achieve that end.
Okay, so according to Mr. Powell, as the economy reopens, we'll see some inflation. Jay, we're already seeing it. You know, we are already seeing it. You look at meat, you look at lumber, you look at gas prices. Oh, but Fed doesn't count energy, right? So maybe they're not counting these oil prices going up. But we're already seeing it. And you may see a surge in spending putting upward pressure on prices. And this is one of the things that we talked about. There's so much money floating around right now. And part of that fear is when the economy opens up or people get vaccinated, go back to work, and this money is going to start coming into the system, pushing prices up. So that's one of the things that has got them on edge right now. We've been in low inflation for decades. It's what people expect. It's almost as if Jay is telling us we've been spoiled. Things were cheap for so long. We've been spoiled. So don't complain if you see a little bit of inflation coming in. Seems that's kind of like what Jay is saying here. One-time effect on inflation. Don't worry, it's not going to last long. And we have tools to manage inflation. We got that printing press. Don't worry, guys. Everything is going to be A-OK. We have that printing press. Something else Jay said.
What I'm wondering is the market now believes the Fed will raise rates earlier and faster than it thought a week ago. Are you saying that's consistent with your outcome-based policy guidance and with your new framework?
It's going to depend entirely on the path of the economy. So I laid out the conditions upon which we would consider raising interest rates, and that's labor market conditions that are consistent with maximum employment, which is, that's a big thing to get to, and it will take some time to get there, right? Inflation sustainably at 2% and inflation on track to run moderately above 2% for some time. So those are the conditions. When they arrive, we will consider raising interest rates. We're not intending to raise interest rates until we see those conditions fulfilled. And so that it's really the timing will depend entirely on the fulfillment of those conditions. And as I said again, if I've told you that we think we're likely to see inflation move up during the course of this year through really two things. First, the base effects I mentioned, but also just kind of reopening effects where businesses will be potentially hit by a lot of demand as the economy recovers, which is a good thing. But you could see bottlenecks, you could see prices moving up. We're inclined to see those as transient. And there's a difference between a one-time surge in prices and ongoing inflation. Ongoing inflation, where prices go up year after year after year, tends to happen when people's psychology becomes that they believe that's what will happen, and they have no faith that the central bank, frankly, will prevent that from happening. So, as I've said, the key thing is to keep longer run inflation expectations anchored at 2%. If that happens, then a transient increase in inflation will not affect inflation over a longer period. And we intend to use our tools to keep inflation expectations anchored at 2%, which gives us the ability to do all of the things we do when the economy is weak.
Okay, so Jerome Powell says expect inflation, but hey, basically, hey, don't worry. We saw the bond market, or basically, hey, don't worry, and we saw the bond market start to move. So Jay Powell is letting you know, although he's very dovish, he has the eyes of a hawk and is watching everything going on. So, all right, Jay, we'll see what happens. So here's some key points of what Jay said according to CNBC, and we'll take a look at some of the CNBC professional pundits. The Fed Chairman Jerome Powell said inflation is likely to rise as the economy recovers, but he thinks it'll be temporary. Without more durable inflation and a return to full employment, he said the central bank is unlikely to raise interest rates, and bond yields climbed as Powell spoke, as the market looked for more commentary on future policy. So here was one CNBC, I think he's a senior financial guy at CNBC, Steve Leisman. Here's what he had to say.
Hey, Scott. Yeah, Powell, let me just turn the sound off here at a Wall Street Journal conference. Sounding very, very dovish, Scott. I want to give you some of the headlines that we have here. He says it's going to take some time to achieve substantial further progress. You remember that's the language that they've used to signal when they might be reducing quantitative easing, but he's not in any hurry. Hey, Scott. Yeah, Powell, let me just turn the sound off here at a Wall Street Journal conference. Sounding very, very dovish, Scott. I want to give you some of the headlines that we have here. He says it's going to take some time to achieve substantial further progress. Hey, Scott. Yeah, Powell, let me just turn
what's going on here?
Looking at that, we'll look through that and see it
Hang
as
on, guys.
temporary. He also notes the Fed has high standards for maximum employment. Goes on to say that unlikely to hit maximum employment this year. Economic outlook has become more positive at the margin. Here's a direct quote. If we see inflation, we will be patient. And the Fed has a commitment not to raise interest rates just because the labor market is strong. I'll go back and listen again, Scott, but I hope you're getting the tenor there. He is in no hurry to do almost anything with Fed policy here. He's not all that worried about inflation, noted the rise in rates, didn't seem like he was going to do anything about it.
I got the tenor. Clearly, I'm watching the market react, too. So, it's the old transitory thing, right? You didn't use that word, but that's basically what he thinks, right? Temporary, transitory for any sort of inflationary pressures that arise, Steve, from this, getting back to the rest of our lives. You say he's so dovish, which we believe. Why is the 10-year spiking?
I don't know if they were waiting for it to clear. They had a trade they wanted to make. There's nothing about this that makes me think Powell is going to raise interest rates or reduce QE any sooner than I thought before this. Two quick things on the inflation thing you talked about. The Fed's view of inflation. You have the base effects, in other words, low inflation dropping out of the year-over-year comparison. That's one. And then second, you have a reopening increase in prices. But Powell keeps insisting that an inflationary process takes many years, and he doesn't believe that the anchored inflation expectations, which have characterized the last several decades, are about to change because of the reopening.
Yeah. Steve, I appreciate
it. Peter Schultz, I see that. Where's Vincent? Patrick needs help. Okay. That is true, though. Always willing to accept and need help. So this was the article where they were kind of referencing Fed Chairman Powell says economic reopening could cause inflation to pick up temporarily. And these key points, Fed Chairman Powell said inflation is likely to rise as the economy recovers, but it's going to be temporary. Without more durable inflation and return to full employment, he said the central bank is unlikely to raise interest rates, and bond yields, of course, climb. This is the video that we just watched. He says we expect that as the economy reopens and hopefully picks up, we will see inflation move up through base effects. Base effects, I tell you what, I think it's just a word it's a soothing word that they're trying to use, and I think we're going to hear it more and more. But this is what Powell said during a Wall Street Journal conference. And he also said that could create some upward pressure on prices. Again, as noted, we're already seeing upward pressure, or let's just say higher prices. The Fed currently is buying $120 billion a month in treasuries and mortgage-backed securities. And this has quietly been going on for a while. And recent market chatter has revolved around the central bank potentially implementing a new version of Operation Twist, in which it sells short-term notes and buys longer dated bonds. In other words, the yield curve is a bit too steep, and what they want to do is push up the short end and hopefully pull down the long end. They're trying to flatten it just a bit. This is Operation Twist. So let's take another peek at what Steve Leisman had to say.
Yeah, Morgan, good afternoon. A bit of a head scratcher about what Fed Chair Jay Powell might have said, prompting bond yields and stocks both to sell off pretty hard, with some pointing to his comments on inflation, very dovish comments, and his failure to commit to act to keep a lid on yields. Powell striking a very dovish tone when it comes to the outlook for Fed policy. Among the things he said, he did note that he had seen the speed of the rate hikes or the yield rise. Previously, they, quote, caught my attention. And he struck a dovish tone, saying it will take some time to achieve substantial further progress, which is the metric the Fed uses to change its policy. And adding to that, saying Fed's not going to hike just because the labor market is strong. Now, Powell essentially reiterated comments he had previously made that higher inflation is coming, but believes it will be temporary and will not be a reason for the Fed to act preemptively to hike rates.
Businesses and people would need to believe that larger increases in prices would be repeated year after year. And we think it's unlikely that these deeply ingrained low inflation expectations would suddenly change. It is more likely.
Okay, so I'll stop it there. So basically, they're saying if we get inflation, it's just temporary. Well, you know, you guys know me already. I have a different view on this. My view is in 71, Nixon said the closing of the gold window was temporary. He also said that was temporary as well. So, you know, there's this thing with the government. Anytime a government says temporary, usually ends up being permanent. Right. So let me take a look at a few of the comments and we'll continue on. All right. So let's see what else is out here is going on. Truth Monster, this is absolutely insane. They insist on expensive housing. Housing is going through the roof. My sister, she's a real estate agent or broker back in Hawaii, and the average home now is over $800,000. And word I'm hearing is there's just not enough homes to sell. And if a home comes on market, it's snapped up within a week. It's bid up and snapped up, usually in a week's time. So yeah, expensive homes. This is something we got to watch for. And again, if these interest rates, if it comes to a point where interest rates do have to rise, a lot of guys who got that second or third home, I mean, I think you may be feeling it. So Powell is also very, very weary about that. But moving from Powell, I want to take a look at something Jim Cramer said over on his show, Mad Money.
Always sounds reasonable, though. And I was going over this with Helene Meisler, some fabulous stuff on Twitter she does. I've known her for 30 years. It's too early. We want to convince ourselves. That's what we're doing. We're convincing ourselves that any decline is merely an interlude. It's a dip that needs to be bought. But when the economy reopens, that changes everything. We already have some nascent commodity and wage inflation in the system. Once you throw in a huge stimulus package, and suddenly lots of investors are worried about an inflation scare, like we saw in late 2015, the last time the economy was coming out of the doldrums. See, at that point, Fed Chief Janet Yellen raised interest rates, and the market took it on the chin, even though we all knew it was going to happen. Well, this time should be different. I mean, today, our more dovish Fed Chief Jay Powell took a different tag. He acknowledged there could be some uptick in inflation. He said, don't worry about it. He practically told us to relax. So what happens? Would it have been better if he'd said we had to raise rates? Probably, because the bond market reacted viciously with long-term interest rates spiking. And that's what took the whole stock market down. And believe me, just go look at his talk. You'll see what he says and then watch the averages. It's cause and effect. In short, stocks are getting hammered because the bond market vigilantes, as we call them, are angry. We've got millions of newer investors, though, who don't even understand, and I don't mean to sound condescending at all, but they don't understand the connection between bonds and stocks. And I got to tell you, I didn't understand it either. Going back to the 5 stages of grief, these people are in denial about how bonds could impact their stock portfolios. And I get that. See, I remember when I was a kid, I got to Goldman Sachs in the early 1980s. There's a fellow, David Darcy, who's regular on CNBC, and he explained to me that I needed to check how the bond market was doing before I said a word about stocks to any clients. I didn't want to hear that. I mean, I was adamant. I said, listen, let me tell you something. I didn't chief him, but I said, let me tell you something. If a company's doing well, its stock's going to go up. Darcy then chiefed me. He sat me down, and he walked me through how the bond market represents the sum of all fears about inflation, supply, and growth. Okay, oversimplification. But all you need to know is that the professionals are taking their cue from the bond market, not the much smaller stock market. So you can't afford to be in denial about this linkage. You're just going to get hurt. Otherwise, you'll never be able to understand what's really killing the stocks of the PayPals or the Home Depots or the NVIDIAs or the Telladocs. And it's not their business. It's the bond market. Sure, if Jay Powell turns out to be right, if there's no tsunami of inflation, well, then we got a different story. I mean, then we probably should be starting buying today. But it could be months before we even know it, if that's the case. We still got to go through these stages. You just do before the market can bottom. And we're early on in the process, sadly, for many stocks in this market. Some are not involved with this, but many are. Denials everywhere.
Don't miss a second of.
Okay, so this came from his website here from CNBC, where Cramer says investors are in denial about stocks. The sell-off is real. Few key points. CNBC's Jim Cramer advised investors to build up cash, and wait for the bottom as the market works through the 5 stages of grief. People don't want to believe the sell-off is real, and if you lighten up, you're going to be ready for the moment of capitulation, the crescendo, the acceptance that marks the trough, Cramer said. So moving down a bit, let's get to some key points of this article. And this is what some people are worried about here, especially bondholders. Fixed income investors worried about inflation that could come up with the U.S. economic recovery are selling bonds, and the activity is bleeding into the stock market. Institutional investors, taking their cue from the bond market, are swapping tech and growth stocks in their holdings for cyclical and value names, and retail investors can't afford to ignore it, is what Cramer says. So with all this, the reaction to Jay Powell's words, I want to touch on bond yields for a bit. I'm not a bond expert, not claiming to be, but I just want to touch on that. And some say the Fed will be doing some form of yield curve control, and some say the Fed is already doing it. Fed is already doing yield curve control, and they have been doing it for quite a while. So with bond yields being so low, being less than the rate of inflation, let's say bondholders having perhaps a 1% yield in a 2% inflationary environment will nominally lose on their investment. So with inflation expectations rising on, say, the rising cost of oil, which we see because when oil goes up, cost of everything goes up. Or let's say the fear of inflation eating up their safe investment, bond investors, they are going to look to sell their bonds, and this is something that we're seeing. So with the economy opening up again, money will move, and that velocity of money surely is going to pick up and be a factor in pushing up prices. So yes, inflation can become very, very real, very, very quick. Bondholders know this, and they're selling. So the Fed can and will continuously buy bonds, which has an inverse effect, pushing up prices while keeping interest rates low. Yes. So remember, the Fed wants to keep these rates low. If the Fed stopped buying up these bonds, prices on bonds will go down, and interest rates would go up. And this is, again, another part of their fear. Now, knowing this, I want to take a look at the 10-year, something that we took a look at a bit earlier. Okay, so right now we see it moving a bit down, 1.57. So here we are today. And, if you just look at this from August to now, it looks pretty steep. And granted, for the times we are in, it has been moving up. But why the fear? Why is there so much fear when these rates are still fairly low if you, let's say, take a look at a longer picture being 5 years? So here we are. And you can see this is really low already. I mean, why is the Fed so worried? Well, if you stay here and you see the horizontal line, you can see that this low, it is a low where it had gone up here. You can see that it's a low again where it had run up here. You can see that it's a low again where it had run up here. So in my view, I think that the Fed knows this, and they're looking at these previous lows are our current high, and this has a chance to run up the same way it ran up here and the same way it ran up there. So I think this is something that is definitely on the Fed's mind, and why they started to I guess freak out might be the word we're looking at. So 10-year yield hitting a high, current high, which is roughly the same as the 2016 low and again the 2012 low, looking back at that chart there. The Fed cannot let that happen this time around. And it does to me at least look like the Fed is trying to stay ahead of the curve and stay ahead of this thing happening again and potentially running. So to me, again, this is what looks like is going on. So it'll do this by, or how do they keep the yield low, or how do they keep the interest rates from running up? They'll buy treasuries and changing the curve to a more gradual curve over time, in contrast to the quick rise that I just showed you in 2012 and 2016. And I'd say yield curve control is or will be something the Fed will soon acknowledge. They haven't acknowledged it yet, but they may soon have to. And it's using, or it's a part of their toolbox, where they're basically going to set a target and they're going to buy it up, buy and sell as much as they need to keep that target. So again, in reality, the tool they are using and the only tool they have is that printing press, or some of you guys noted, it's really just a keystroke. So let me go back a bit. Hang on, okay. Yeah, let me just go back a bit. So to make a little bit of sense of this, I called Michael Pento, and he was kind enough to go ahead and speak with me for just a little bit, and I want to go ahead and share that with you. Does yield curve control distort how an investor might want to invest?
Well, of course. So yield curve control, I don't know if that's something the Fed is actually avowed that they're doing, but they are doing it. So they're buying $120 billion every month of bonds. So 40 billion mortgage-backed securities and 80 billion in US Treasury. So they are, in fact, distorting the yield curve, massively distorting the yield curve, if you want to know the truth. Yield curve control, when people say that, I guess what they're really saying is the Fed going to cap long-term interest rates. So I think if they did that, it would be a monumentally huge mistake. They're not doing that at this time. I think what they're more apt to do is just continue buying across the curve. And then if the 10-year note continues its inexorable rise, then they might do something called an operation twist, where they would just sell short-term treasuries and buy long-term treasuries, or more long-term treasuries. Or they could just increase QE and just say, okay, we're going to do 100, whatever number of just long-term bonds.
Yeah. Is it possible where they might do a operation twist and a yield curve control simultaneously?
Yeah. So I mean, that's one of the ways, like I just mentioned, that's exactly what they would do. That's one method of saying, okay, we'll just buy more. We'll sell. We're not going to buy as many short-term, or we'll sell short-term treasuries and buy more long-term treasuries, which is like an operation twist to keep the long end in check. And we could talk about that in a moment, but I really don't feel that the central bank of the United States or any central bank has that much power in reality.
Okay, so I mean, let's say is the Fed eventually, ultimately, via yield curve control and whatever else they can think of, are they going to be the only buyer or the only significant buyer of U.S. debt? And if so, what would that mean?
Well, they're already a very significant buyer of U.S. debt. I mean, they're heading towards becoming like Japan, where the JGBs don't trade; they trade by appointment, and the Bank of Japan is the primary buyer. So that is a huge problem. And of course, if they do engage in this yield curve control or put a cap on long-term bonds, they could drive the entire private sector out of the bond market. I mean, let's be honest, Patrick. There's relatively small participation in the private sector for these bonds at this price. I mean, if you think if the Fed were to ever say, I am getting out of the business of QE, no longer buying bonds, I think you would find zero net participation in U.S. Treasuries at 1.4% or 1.5%, just a ridiculously low yield when you're looking at nominal GDP heading towards 6 to 8%. I mean, if you have 4-5% real growth. What the heck is a 10-year note doing at 1.4% and inflation going towards 3%? The way the Fed measures it, that's just insane. So yeah, there would be without the Fed's massive and indiscriminate bid for treasuries, I don't think anybody would buy a treasury at these rates.
Okay, and I guess last question here. If nobody's buying the treasuries, what's it going to look like? I mean, what's going to happen?
Well, if nobody buys a treasury, I think a better question is if the Fed is the only buyer of treasuries on on the long. If they say, listen, inflation is getting out of control, and the bond, and that's causing real interest rates to go spiking bonkers, towards the thermosphere, and emerging markets start blowing up, and we starts to spill over into credit markets, and then the regular averages start to crash, and we'll say, oh, we'll fix everything by printing more money and buying long-term treasuries. Well, that usually has worked very well in the past when deflation was the problem. When yields are spiking, not because of so much a solvency issue, but because of inflation and insolvency concerns, then you got a whole world of hurt. I don't think the Fed can print enough money to make people not be worried about inflation, because printing money is inflation. So I don't know how you can fix an inflationary collapse of long-term bond prices. So prices collapse, yields up. How do you fix that by promising to create more inflation? We'll find out, but that's probably where we're headed.
Okay, so with all this going on, hey, pretty much what could go wrong? Well, here's what could go wrong. So I just want to scroll down a bit just to the part we need, and let me go ahead and make this larger so we can take a look at it. Okay, so let me scroll down to the part I need. Okay, let's just go from here. If the policy persists after the pandemic is over, there could be problems. The first is that nobody really knows the effect of Fed interest rate caps on the economy during normal times. And a few economists worry persistently low rates give rise to unproductive zombie companies that survive only by rolling over cheap debt and compete healthier companies out of the market. It's also possible low rates could benefit from big companies more than small ones, exacerbating the problem of monopoly power. Second danger, inflation. We already know zombie companies, they may be sucking credit, sucking liquidity that perhaps better or other companies could do a better job with. But the second danger is inflation. Right now, with demand crushed by the pandemic, inflation seems unlikely. But when normal times return, yield curve control could cause prices to rise. If investors are unable to get a premium for buying lower term treasuries, they may abandon the market, forcing the Fed to step in and actually buy the long term bonds to maintain its rates or its rate targets and keep government borrowing costs low. And yield curve control could lead to a situation known as fiscal dominance. Okay, fiscal dominance fiscal dominance might be a word we may not be familiar with. It's a new term. Let me see. In which monetary policy becomes subordinate to the needs of Congress. Okay, monetary policy becomes subordinate to the needs of Congress. If businesses think the Fed will simply create as much money as it needs to finance government deficits, then they may expect a spike in inflation, and this would cause them to raise prices, making inflation a self-fulfilling prophecy. And that might be what happened in the late 1940s when the Fed kept controlling the yield curve after the war, but stopped doing so after inflation rose to 17%. So this isn't new stuff. It isn't anything new, and we see what history tells us back then, where we saw inflation rising to some 17%. Transitory? Temporary? Not so sure, right? Time will tell. So let me take a look at a few comments before I show the last clip and go through some commentary here. Stephen Brown, Yeah, that's part of the problem right here. The numbers that they give, uh, John Williams, for example, as Gerald Celente mentioned, he has very, very different numbers as far as either inflation goes, unemployment goes. He has very, very different numbers, and mostly because he measures it the way the Fed used to measure it, and then the Fed decided not to add in energy, not to add in food. But if he did, it would be much, much higher. So again, the numbers, as you mentioned, it just depends what kind of data you want to put into it, and how you want to skew it to be to fit your narrative, or to give people an outlook that you desire them to have. So, okay, it's a good comment there. Let's see if I can take a look at another comment, then I'll just play one more clip. Let me see. Okay. Um, okay. We'll just to sum it up. I think some of you may be familiar with Hearsay Financial, so I just want to go ahead and play his clip. I think it's just 2 or 3 minutes long, but he pretty much summarizes it in a way that really hits home.
Similarly, bonds right now are trying to respond and adjust to what they're actually worth based on inflation expectations. If you expect inflation to go up, you're going to demand a higher interest rate on your debt. But if a buyer comes in and says, we're targeting a specific price for bonds, which is the inverse of the interest rate. We're targeting a specific price point, so we will buy and sell any amount necessary to get it at that exact price. Well, bonds aren't worth that right now. Bonds are worth a price point which increases their interest rate to compensate for inflation. But if a buyer comes in and says, we're going to pay a lot more for bonds in order to push down the interest rates and peg it at a certain price, and it doesn't matter how many of these things hit the market, guess how many of these things will hit the market? All of them. And I'm not making stuff up here. This is what's happened in other countries that have tried yield curve control in the past. The central bank absorbs the entire debt market. And the reason they will have to do this is because fundamentally, asset prices are determined by the credit of the companies that they represent. And if this whole credit market blows up, it destroys asset prices. But more so than that, credit markets like treasuries are what give the dollar its value. And so in order to keep the dollar having some global demand, they have to keep the price of treasuries elevated, meaning the interest rates low. But the irony of this is that in order to do that, they have to print more money, which is diluting the purchasing power of the existing dollars in order to do that. And we've seen this happen before, most famously 300 years ago in France. John Law and his Mississippi bubble, he printed money. He got a bank charter that became the central bank in France. He issued new paper money after illegalizing and getting people to stop using silver and gold as money. Everybody uses paper money, and it was backed up by shares of his Mississippi company, owned land in America. And in order to keep the value of his paper money inflated, he printed money to buy the shares of the company, the Mississippi company. Well, when you have to print money in order to buy shares of something to keep the value inflated, because the value of these things back up the value of the thing that you're printing, eventually that blows up. And that's exactly what the Federal Reserve and the United States government have to do today, between a rock and a hard place. This is the game that they're playing. It's really the only option right now that they have, other than just letting it all collapse right now, which means that the likelihood that we are on the verge of extremely high inflation, price inflation, over the next couple of years is extremely high.
Okay, so he pretty much sums it up, and a lot of very, very similar things happened then that we are seeing happening once again. As we say, nothing new under the sun. Got rid of silver and gold as money, right? Gave us just that paper. Anyway, why is this a topic for us to know? Well, more than anything, this is for us to understand and see once again how the Fed, how central banks, how governments manipulate the markets. Yield curve control, QE, they do skew the markets. We're not getting the right information that we need. We have a meme economy now where anything an authority says, for instance, Jay Powell, right? Anything an authority says, a celebrity says, the news media says, social media says, forums say, all drive investments or money here, there, everywhere. Seems whoever has the largest platform, loudest voice, they seem to move money around. And yes, maybe it's always been this way, but certainly not to this magnitude. And with this uncertainty and uncertainty easily outweighing certainty, holding assets that can weather the storm ahead is a must. Now, no one can predict the weather. No one can predict the weather. However, if you feel the air pressure dropping around you, you know how that feels, right? If you see clouds getting a bit heavier, if you see them starting to roll in, getting a bit darker, you don't need a weatherman to tell you take cover, to start taking shelter. You just know. You know it, you see it, you smell it, you feel it. You just know. And again, right now, what's happening right now, you just know. It is surely time to start picking up safe haven assets like gold, like silver. It's not financial advice, just sharing the things that I do. And without question, it's time. Um, it is time. So always be listen to what you can, take in what you can, think about it, critically think about it, and again, look at things for yourself. See things how you want to see it, not for what other people are telling you. So, as always, like I said, your comments here are probably the most important thing because there are people on the fence. I can say, what whatever it is that comes to my mind, but when they see your comments out there, that's the thing that truly makes a difference. So you have an opportunity to help out a lot of people. As I say, we're in the same boat together, without question. So let me take a look at a few comments before we wrap this up. Um, okay, let's see what's going on out there. Okay, Ken D. No secret though, high inflation, so the Fed has to cap rates or the government collapses unless they print it out of the wazoo. How many plates can they keep spinning at once? Well, maybe that's why they had to get Janet Yellen in there. She's a plate spinner as well, right? So Jerome Powell is spinning some plates. Yellen, she knows how to spin plates. So we got the Wonder Twins out there trying to spin all these plates together, as many as they can. Who knows? It's not too bad, right? I didn't say anything that bad by saying that, right? Okay. What else is out there? Penny pinching prepper, buy silver, gold, and miners. That's what a lot of people are saying. True. That is what a lot of people are saying. Silver, gold, and miners. If you want the physical exposure to physical, you buy the physical silver and gold. And just keep in mind, miners, you're not necessarily exposed to the physical price of silver and gold because when you buy miners, you're also buying management. So with miners, always do your homework, due diligence, right? So, okay, good point. Appreciate that. And let's see what else is out there. Maybe one more comment, and then we'll head out. And Ken D, you're on a roll. One more here. The odds of a financial crisis are directly proportional to how much the Fed feels it fixes problems by adding more spaghetti to throw at the wall. That's a descriptive picture of what's going on back there. So we'll leave it up to the Wonder Twins, Janet and Jerome. They're both spinning those plates back there and, trying to see what else they can do. But in the end, all they have is that printing press and adding of keystrokes. So again, as that money supply increases, it's one part of the recipe for inflation. We're hearing more and more inflation. And as the economy opens up, we just might see it. How fast? Can't tell you, but everyone is pretty much saying with the certainty you're going to start to see it, if not seeing it already. Is it temporary? Temporary is a word the government likes to use, which ends up meaning permanent. So again, appreciate you all being here. Robert Carter, you have a good day as well. Rick Golfman, we appreciate it. Tree Climber, Sarah Brown, appreciate you guys all being here. Polynesian Pip, going to be heading out, and just remember we're in the same boat together. Keep in mind, as much as possible, be a blessing. Be a blessing, not a burden. A lot of people out there are going to need help. Help them how you can. Your friends, your family especially. You got to take care of yourself first before you can help anyone else. You have to be in the right position first before you can help anyone else. So we need to take care of these things on our own first and foremost, and then hopefully we can be that blessing and not a burden. So as I always like to say, saddle up for what's coming ahead and silver up. I'll see you next week. Take care.